Welcome back, everybody, to Volatility Trading Strategies. So some of my favorite questions to answer are the ones that are specific to the trading strategies themselves. It usually means that people are interested in perhaps trading them, and they're just trying to iron out a few of the details. So today's topic is all about the VTS Tactical Balance Strategy. Now, just as a reminder, or for people who are new here, this strategy makes up 50% of our total portfolio solution. My volatility and iron condor strategies are 25% each to make up the rest. So this tactical balance strategy could be considered the core holding. It's tactical because it's not buy and hold. It actually rotates between three possible positions, either stocks, bonds, or gold. And it will only ever hold one of those positions at any one time. So the long-term average allocation for each of these positions is roughly 50% of the time we're in stocks, about 25% of the time we're in bonds, and the remaining 25% we're in gold. This year, however, because it's been so stable and consistent, the markets are setting records for low volatility, we've actually held equities over 80% of the time through 6 months of 2017. We basically just take what the markets give us, and this year it's been pretty heavy on equities. But that's just a reminder of the strategy. Today's video is why I actually choose the tickers that I do to represent those allocations. So when we're holding stocks, we use the ETF called MDY. When we're in bonds, it's the IEF, and when we're in gold, we use the GLD. There's dozens of ETFs out there to represent those asset classes. So the question becomes, why did I choose those three? Let me explain. All right, so I'm just going to go through them one by one and explain my rationale for choosing each of them. And we'll start with the easy one, the GLD, which represents our gold holdings. All of my strategies have both bull market and bear market components built into them. As they say, everybody's a genius in a bull market. So the GLD is our go-to holding for extended market sell-offs, and it might do reasonably well during the next recession. So why the GLD? Why not IAU or SGOL or DGL? There's plenty of gold ETFs out there to choose from. So the first reason is because the GLD doesn't just track the price of gold, it actually holds physical gold. It stores it in vaults, and it really only sells gold when it has to pay expenses or to honor redemptions. Now, some of the other ETFs do this as well, so it's not the only reason. But another reason is that the GLD is by far the largest. It actually holds about 3 times more physical gold than all of the other ETFs combined. So stability through size, basically. And lastly, a minor reason, but still important, the GLD has actually been around the longest. So for strategy building and number crunching, it's important to have a long live trading data set, and the GLD provides that. So in my opinion, the GLD is the best choice here. Moving on to the allocation that represents bonds, we use the IEF. Now, technically we're talking about treasuries, but it's more or less the same thing. And again, there's many ETFs to choose from. There's the TLT, BND, SHY. Again, there's dozens of these. Remember, the bond market is much larger than the stock market, so no surprise here, there's plenty to choose from. The most common question I get asked is, why not the TLT? So before I get into my reasoning there, I just want to explain a few things. This isn't a bond video, but there's a couple of things that people need to be aware of. And the first thing is, bond prices rise as interest rates fall, and vice versa. So looking at this chart, it's no surprise that it's been a 35-year bull market run in bonds. Interest rates have been steadily falling since the early 80s, and that's been good for bond prices. It's no wonder baby boomers like investing in bonds so much. Through much of their retirement investing time horizon, it's just been great bond returns for decades. But with interest rates now nearing historical lows, the bull market in bonds is probably ending, and that's not me making a market prediction. I'm saying, mathematically speaking, to duplicate this again from here would require bonds to go into deep negative territory, and that's just not going to happen. They can go negative, and we've seen that in a few countries already, but they can't go negative enough to sustain this run. So given that it's likely that interest rates probably at best will remain roughly where they are now, and perhaps could even rise as central banks start tightening, the best way to increase safety is to reduce the bond duration. Now, the TLT holds 20-plus year treasuries, which does leave it exposed to a rising interest rate environment. But going too short, say 1 to 3 years, at that point the yield is so low it's hardly worth holding them. Now you can increase that by lowering the quality, but we're not looking to take on any credit risk here, so finding a middle ground between these two, I've selected the IEF, which is 7 to 10 year treasuries. I'm not expecting killer returns, but I do think it strikes a nice balance between shortening the duration and still getting a decent yield. So for that middle ground position in our strategy, when the markets aren't quite stable enough to be holding stocks and they aren't selling off hard enough to warrant a gold position, I have chosen the IEF, and I think it's the best choice. Now moving on to the last holding, which as I mentioned averages roughly 50% in the long run, and that's stocks. Now it'd be easy to do what most people do and just hold the S&P 500. And to be honest, most of the questions I get asked about this strategy are exactly that. Why don't we trade the SPY instead of the MDY when we're in stocks? And to see the answer to that, it's best to just look at the performance. So for those who aren't aware, the SPY is an ETF that tracks the S&P 500 index. The MDY is an ETF that tracks the S&P Midcap 400 index. So they're both broad holdings of some of the best companies in the world, but the MDY has an average market cap that's a little lower than the SPY. Now, if I put both of these ETFs through a backtest of my strategy, these are the results of just the stock portion. This is not including bonds and gold, of course. You can see the MDY is the clear winner, and this is also true when comparing long-term buy and hold of these as well. The MDY has outperformed the SPY, but it's even more pronounced within my strategy, and the reason for that is the MDY tends to perform better during strong bull market periods, and the SPY tends to perform better during bear markets. Since my strategy uses input variables that successfully filter the markets and only trade when the signals are the strongest, those tend to be the times when MDY is outperforming the SPY, and we can benefit from that. During the times when the input variables have degraded, that's when SPY outperforms the MDY. But at those times, my strategy is in bonds or gold, so we don't really care, and that's why we trade the MDY instead of the SPY. Now the last thing I'll say here, since I've got the chart pulled up, this blue line for the MDY, a 10% annualized return, that's significantly higher than a buy and hold on the S&P 500. Anytime we can outperform the stock market while only being exposed to it 50% of the time, that's true risk management. Then we get to add on the bonds and gold returns as well. And this is why the tactical balance strategy nearly doubles the S&P 500 in the long run. So hopefully that answers a few questions. There's definitely reasons why we trade the GLD, the IEF, and MDY. Now they're not written in stone. I am data dependent and constantly trying to improve on my strategies. So if the markets do change in the future, or maybe new ETFs that are better become available, I'll certainly be open to switching. But for the time being, these are the ones that we're going to go with. So as always, if you have any questions at all about this topic or any others, please feel free to email me anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you, so go ahead and leave those in the comments section. See you next time.